Scalping, trading strategy. Scalping is a short-term style of trading. In this video, you will learn about this style of trading, and also understand to use some highly effective scalping trading strategies. So, what is scalping? Scalping is a trading technique that involves entering and exiting from the market in a very short period of time to obtain a quick profit. This trading method has gained huge popularity in recent times. It is used on smaller time frames, starting from just 1 minute. The scalping strategy is equally effective for forex, stocks, commodities, or any other financial market. Using this technique, traders place high-frequency trades, and this requires high volatility to enter and exit in short period of time. That is why forex is considered a more convenient market for scalping. There are several ways you can scalp the markets. You can scalp by visually analyzing the price action and predict the price movement. You can simply rely on the candlestick patterns or the Western charting patterns to look at the price action and place the trades. You can also use technical indicators and oscillators like the moving average and the RSI. The technical indicators and oscillators can be used in isolation, or you can use them together for better signals. So to wrap up, scalping is a style of short-term trading, and it requires high volatility to enter and exit from the market. So, what is an effective way to scalp the markets? The right way to scalp the market is to have a high-performance scalping strategy. There are several trading strategies available. However, not all strategies are high-performing strategies. In this video, you will learn about multiple scalping trading strategies that are effective, easy to learn, and they will keep you on the right side of the market. We will first start with a simple strategy, and then move on to more complex scalping strategies. The first strategy that you are going to learn is simple and effective. It is based on the moving average indicator. Scalping strategy using 2 moving averages. Before we go into the strategy details, let's briefly understand what a moving average is. The moving average is a simple technical analysis tool that smooths out price data by creating a constantly updated average price. The moving average is a famous technical tool that you can find on any trading or charting platform. You can choose a particular period and apply the moving average on any instrument and start analyzing the market. Moving average strategy breakdown. So what exactly is our strategy? Our strategy is to use 2 exponential moving averages, one with a 50 period, and the other with a 200 period. The idea is to trade when the 2 moving average crossovers. The crossover produces a bearish or bullish signal, and based on the crossover, we will place our trades. What are bearish and bullish crossover? A bullish crossover takes place when the short-term moving average crosses the long-term moving average from below. A bullish crossover signals that the price is likely to rise, and as a trader, it's generally a buy signal. Likewise, a bearish crossover takes place when the short-term moving average crosses the long-term moving average from above. A bearish crossover indicates that the market is likely to drop, and traders take it as a sell signal. Now, based on our moving average strategy, we will use a 5 minutes candlestick chart and take a buy position when the moving averages produce a bullish crossover. Meaning, when the short period moving average crosses above the longer period moving average. The stop loss in this trade will be just below the 200 period moving average, while the take profit will be double the size of your stop loss. Similarly, we will take a sell position when the moving averages indicate a bearish crossover, or in the other words, the short period moving average crosses below the long period moving average. The stop loss for this trade will be above the 50 periods moving average, and the take profit will be double the size of your stop loss. Now, let's look at our strategy in action. Following our strategy, 2 exponential moving averages, with 50 and 200 periods, are applied on your JPY 5 minutes chart. The 50 period EMA color is red, while the 200 EMA color is blue. You can see that the market has been largely trading sideways. However, just around 128.70, the price started to rise, and around the same time, the short period EMA, crossed above the longer period EMA, which is a bullish signal. So, following the bullish signal, a buy entry is placed, with a stop loss just below the EMA 200. Let's see on the next screen how the market moved. On this chart you can see, following the bullish crossover, the market moved up from 128.80 to almost 129.20 before starting to fall again, which is a huge profit. However, in scalping, the target profit usually remains small. You could close this trade in 20 to 25 pips profit. But sometimes, looking at the strong bullish momentum, one way to benefit from the entire rally is to use a trailing stop loss. Now, let's move to our next strategy, in which we will use two indicators to make the strategy even more effective. Scalping strategy, using two indicators. In our first strategy, we have used two exponential moving averages, and it was based on their crossover. In this strategy, we will use only one exponential moving average, and with that, the second technical indicator will be an oscillator, which is the relative strength index, or RSI. RSI is a momentum indicator. It is generally used for identifying the oversold and overbought zones. It's available on all the trading platforms, and when applied on a chart, it gives a reading between 0 to 100. The 50 is a neutral zone, while reading near or below 30 is considered an oversold indication. Likewise, a reading near or above 70 is considered overbought. Strategy breakdown. Based on two indicators strategy, we will place a buy trade when the RSI is above the neutral zone, and the moving average line is below the current price. Having RSI above the neutral zone indicates the market is headed upwards. Likewise, having the moving average line below the market price indicates a support area. The stop loss in this trade will be just below the moving average, while the take profit in this trade will be when the RSI reaches near the overbought zone. To place a sell trade using our strategy, the RSI needs to be below the neutral zone, and the moving average needs to be above the current price. Having the RSI below the neutral zone indicates that the market is headed lower, and having the moving average line above the current price is an indication of a resistance area. The stop loss in this trade will be above the moving average line. The take profit will be when the RSI line reaches near the oversold zone. Now, let's have a look at our strategy in action. Based on our strategy, a 50-period EMA and the RSI are applied on the Euro/CAD chart, which is set to 5 minutes interval. You can see the pair is having two-way movement and no clear direction is available. However, near 1.46800, the RSI moved above the neutral zone. Around the same time, the price that was keeping below the EMA also moved above the EMA line. Following our strategy, this is a bullish signal. So a buy trade is placed at 1.46800. The stop loss is kept below the EMA around 1.4665. Now, let's see what happened after our strategy gave a bullish signal and we placed a buy trade. Now on this next screen, you can see the performance of our strategy. Soon after taking the buy trade, the pair moved higher, towards 1.4700. You can also see, around this level the RSI entered the overbought zone. And based on our strategy, we can close our position here in 20 pips profit. Alternatively, to benefit from the entire rally, you can also use a trailing stop loss.